In this video, we will look at 3 dividend stocks from Dividend Aristocrats ETF. All the stocks from this ETF managed to increase their dividend for the last 25 consecutive years. So this ETF consists of established companies that managed to increase their dividend. The problem is that you buy this ETF, ticker NOBL, you get a dividend yield of close to only 2%, while if you buy SPY, you get a dividend yield of close to 1.5%. And SPY has a lot of growth stocks. It has a lot of tech stocks that offers much higher growth potential. So is this 0.5% worth it? So maybe a better idea is to buy the best stocks from this ETF, stocks that have high profitability measures, that offers growth potential, and are not very expensive. So we will look at 3 stocks from this ETF. So let's get started. First of all, if you want to get updates on dividend stocks or other investment ideas, you can subscribe to the channel by pressing the subscribe button under the video. You will not miss a single new video. Okay, so the goal here is to find 3 dividend stocks from Dividend Aristocrats ETF, ticker NOBL, that offers growth potential, that have high profitability measures, and can be bought at a reasonable price. So the first stock that we are looking at is Grainger. It produces tools and equipment. We will use our tool for the analysis. Okay, the first stock that we're looking at is Grainger, ticker GWW. It's from the industrial sector. Its market cap is close to 29 billion. We can see that they have net debt of 2.4 billion. If we compare that to free cash flow, we can see that it is 3.5 times free cash flow. So the debt seems to be manageable. They have a dividend yield of 1.15% and a payout ratio of close to 49%. So the payout ratio of less than 50 is something that I want to see in a dividend stock. So the dividend seems to be stable. We can see that they have high return on assets and relatively high return on invested capital. If we look at their margins, we can see that they have high gross margins and high operating margins. If we look at their valuation, we can see that the price to sales, price to earnings, and price to free cash flow are in line with the sector averages. So they get overall rating of 64. This combines valuation grade, profitability grade, and growth grade. Okay, so we looked at Grainger. So how this grading system works. In many ways, this is similar to Magic Formula. In his tool, Joel Greenblatt used only 2 metrics. How good is the company and how cheap is the company? The problem with that is that reading his lectures, I know that he used trailing 12-month earnings, but in his personal portfolio, he used normalized earnings. So he projected earnings into the future. So in our tool, we use profitability measures. So how great is the company? We use also price metrics. How cheap is the company? And what is the growth rate? So this is the 3rd metric. And we graded these companies on 3 metrics. As a result, we get the total score. Also, an important difference is that we are comparing stocks compared to its peers, so in the same sector. Okay, the second stock is Archer Daniels Midland, ticker ADM. Again, we will use our tool for the analysis. Okay, the next company that we're looking at is Archer Daniels Midland. They produce various farm products. It's from the consumer defensive sector. The market cap is close to 51 billion. If we look at some of the ratios, we can see that they have net debt of close to 11.5 billion. If we compare that to their free cash flow, we can see that it's 1.7 billion. So it's more than 3 times free cash flow. So debt might be an issue. We need to pay close attention to their debt. They have a dividend yield of 1.7% and a payout ratio of close to 52%. So the dividend seems to be stable. If we look at their valuation, price to sales, price to earnings, and price to free cash flow are below the industry averages. So that's a good sign. They have overall rating of 67. This includes valuation grade, profitability grade, and growth grade. Okay, so the 3rd stock is NUE. So again, we will use our tool for the analysis. Okay, the next company that we're looking at is NUE, ticker NUE. It produces various steel products. It's from the basic materials sector. The market cap is close to 38 billion. If we look at some of their ratios, we can see that they have net debt of close to 5.1 billion. If we compare that to their free cash flow, debt not seems to be an issue. They have free cash flow of more than 7 billion. They have a dividend yield of 1.35% and a very low payout ratio, close to 7%. They have very high return on assets and return on invested capital. Return on invested capital is earnings divided by capital, which is equity plus debt. If we look at their valuation, we can see that price to sales, price to earnings, and price to free cash flow are below the industry averages, so that's a very good sign. Their overall rating is 86. This includes their valuation grade, profitability grade, and growth grade. Okay, so we looked at 3 dividend stocks. They have 4 things in common. First, they have stable dividend. They managed to increase their dividend for the last 25 consecutive years. They have also low payout ratio, so the dividend seems to be stable. They are not very expensive compared to its peers, so it is possible to buy them at a relatively attractive valuation. They have high profitability measures, gross margins, profit margins, high return on invested capital, and they also offer growth potential. So not only they are bringing stable dividend, they offer growth potential and reasonable valuation. Also, if you want to know more about the recent purchases of super investors, here's the video about Seth Klarman. If you are not subscribed to the channel, you can press the subscribe button right here. You will not miss a single new video. Thank you very much for watching to the end, and see you in the next video.